Cooper. I'm Bradley Cooper, the CPA. And I wanted to talk a little bit about LLCs and S corporations. First, we need to understand what an LLC is. An LLC is a company that is set up by each state. It gives each company different rights and obligations for the carrying on of the business of that company. However, the IRS is responsible for taxing these LLCs. There are three ways that we tax companies in this country. One is a sole proprietor, two is a partnership, or three is a corporation. You didn't hear me say LLC there, and the reason is that the Internal Revenue Service does not tax LLCs as a particular company. What they do is they allow you to choose how you're going to be taxed. So if you're an LLC, you can be taxed as a sole proprietor, a partnership, or a corporation. However, there are some limits. If you are a single member LLC, you can only choose sole proprietor or corporation. If there are two or more members of the LLC, then you can choose partnership or corporation. So with that information in mind, we will choose how we are going to be taxed. What if we choose to be taxed as an S corporation? How does that work? First, I would like to talk to you about the requirements for being an S corporation. Not every corporation can be an S corporation. Some of the requirements are these. One, only individuals can be shareholders of an S corporation. One, individuals, estates, and trusts are the only folks that can be a shareholder in an S corporation. Partnerships and C corporations cannot own stock in an S corporation. Two, only U.S. citizens or residents can be owners of an S corporation. Three, the corporation can only have one class of stock. Now I'll talk a little bit in a few minutes about what that really means, but right now we need to know it can only have one class of stock. And fourth, we cannot have more than 100 shareholders in an S corporation. Some of the advantages of filing as an S corporation is these. One, S corporations don't pay tax on the income that is generated from the company. The shareholders pay tax on the income that is generated from that company. Let's compare that to a C corporation. If a C corporation generated $100,000 worth of profit, it would pay about $20,000 in income tax. If the corporation were to distribute that $80,000 to the shareholders, then the shareholders would pay tax on that $80,000 again. That $80,000 then would have been taxed twice, once at the corporate level and once at the shareholder level. The beauty of an S corporation is that it doesn't pay tax. Only the shareholders pay tax. So in that same scenario, if we had $100,000 in profit, the shareholders would pay tax on that profit, and it would only be taxed one time, not twice. Therefore, we are able to get out of that double taxation that a C corporation has. A second advantage that an S corporation has is that the profit of the company is not subject to Social Security tax. Let me give you an example to illustrate. Let's assume that the company generates $50,000 worth of profit and the owner takes out $30,000 to live. If we were to file this as a sole proprietor or a partnership, the rules are going to apply exactly the same to each entity, then the $30,000 that is paid to the owner does not come into play. Nobody cares about that, not even a place to put it on the tax return. However, let's assume that the company generates $50,000 in profit and the owner takes out $30,000 to live. How is that going to be taxed? If the company chooses to be taxed as a sole proprietor or a partnership, the rules are going to be exactly the same. And those rules are: the owner will pay income tax and Social Security tax on $50,000. The $30,000 that the owner took out doesn't even come into play. Nobody cares. There's not even a place to put it on the tax return. However, if the LLC decides to be taxed as an S corporation, how would this be taxed? The $30,000 that was given to the owner now does come into play. That $30,000 will be treated as a salary to the owner. The owner will receive a W-2 for that amount, and it will be deductible from the corporate profits. So instead of making $50,000 in profit, it deducts the $30,000 W-2 and now has $20,000 in profit. Let me explain how that is going to be taxed to you. The owner will pay income tax on the $30,000 W-2 and the $20,000 in profit. That's $50,000. That's exactly the same amount that they would pay income tax on if they filed as a partnership or a sole proprietor. So there's no income tax savings regardless of how we file. However, the tax savings are going to be this. It's Social Security taxes. As an S corporation, the owner will pay Social Security tax on the $30,000 W-2. The $20,000 in profit is not subject to Social Security tax. Compare that to a partnership or a sole proprietorship where the owner will pay Social Security tax on the entire 50. We can see that we are saving Social Security tax on the amount of profit if we file as an S corporation. Social Security tax is 15.3%, but at 15% of $20,000, that's $3,000 that is saved if we file as an S corporation. If the owner chooses to file as a sole proprietor or a partnership, they will write a check to the IRS for that $3,000. Therefore, many of my clients choose to file as an S corporation if they are an LLC, so that they could save those Social Security taxes. However, there are some disadvantages with an S corporation. One disadvantage is that you cannot allocate profits however you want to. You must allocate profits based on ownership percentages. 2, the tax preparation of an S corporation is quite complex. They have many laws that only apply to S corporations, and they can affect how you report your income and expenses and when you report those income expenses. I would recommend that after you listen to this and learn a little bit more about S corporations, that you find a tax preparer that knows at least as much about S corporations as you now do. We prepared corporate tax returns for companies throughout the United States. If you would like us to work with you on preparing these tax returns, we would be happy to do so. 3, losses are limited to basis. Let me explain what that means. Basis is calculated as the amount of money you put into the company minus the monies that come out of the company for you that are going to be classified as distributions. Some people might use the term dividends, but dividends is used in the context of a C corporation, not S corporations. But they're really synonymous terms. Plus profits that are generated from the company, less losses that are generated from the company. That will give you basis. Let me illustrate how that works. Let's say that in year 1, you contribute $10,000 to the company in exchange for an ownership interest in this LLC. And during the year, the company distributes $8,000 in dividend distributions to you. You now have a basis of $2,000. Let's assume that the company loses $5,000 during the year. Your loss that you can deduct is going to be limited to basis. So you've got a $5,000 loss. It's limited to the $2,000 in basis. So you can deduct $2,000 on your tax return. What happens to the other $3,000? It is called a suspended loss. We will carry that over to next year. So let me illustrate how that works. Let's say in year 2, you do not make any more contributions to the company, nor does it make any dividend distributions to you. And let's assume that the company generates a profit of $5,000 during the year. You would have to pay income tax on that $5,000 minus the $3,000 in suspended losses that were carried over from the prior year. Therefore, you would only pay income tax on $2,000 this year. So that's how basis works. Not only do you have a basis in your stock, but you could also have a basis in your loans. So you can contribute money to the company in the form of a loan and increase your basis. However, if you take money out of that loan, you decrease that basis. And again, the purpose of increasing that basis is so that you can deduct those losses today and not suspend them to a following year. Another disadvantage of an S corporation is that the Internal Revenue Service requires that the owner take a reasonable salary. Now, the law does not define reasonable, nor does it give us a formula to compute reasonable. So we have to look to the courts to see how they have defined reasonableness. They've done it in many ways, but the two most common ways is this. One, how much would the company have to pay someone to do the work that you're doing? Now, usually wages that we pay someone come in a range. So let's assume that the range is that we could hire someone to do your work between $10 and $12 an hour. If that's the case, we want to pay you the lowest reasonable salary that we can, so we'll pay you $10,000. So we will pay you $10 an hour. The second way is a percentage of income. Let me give you a court case as an example. Many years ago, there was a surgeon who owned an S corporation. He decided the company would pay him $30,000 a year, and the company generated $270,000 worth of profit in excess of the $30,000 it paid him. The IRS came in and audited him, thought that the wage was unreasonably low, so they went to the judge to see what the judge would say. The judge reviewed the case and noticed that the surgeon had several nurses that assisted him through the surgery and the recuperation of his patients. He had several people behind the desk who made appointments and took payments, but also recognized no income was generated from this company until the surgeon picked up a scalpel and started cutting somebody. Therefore, the judge decided that the majority of that income belonged to the owner as a salary and not a distribution. We can see from this court case that the court looked at the relationship of the work that the individual did, the work that the owner did, in relationship to work that others do. The more work you do in the company, the higher that percentage needs to be. The more work that others do, the lower that percentage can be. But we also see that if the profit were low, let me use as an example $20,000, and we gave you a $10,000 salary, 50% of the profit, you may find that the reasonable salary in this situation would be $10,000 per year. We may also find that if the company had to hire someone, it would have to pay them $10 an hour. That equates to about $20,000 a year. So now we have two amounts as a reasonable salary, $20,000 and $10,000. We are going to choose the lowest reasonable salary that we can in order to save Social Security tax. In this example, we will choose $10,000. Now, when the company pays a wage to its owner, a couple of things have to happen. One, the company has to deduct taxes from the owner's salary and has to submit those taxes to the Internal Revenue Service. They do that either once a month or once a quarter, depending on what the amounts are. In addition, the company has to file payroll tax returns with the Internal Revenue Service and most likely the state in which you're living in for unemployment taxes. The company also has to file some annual reports and W-2s at the end of the year. This could be quite expensive if you have to hire someone to do that, or time consuming if you have to do those reports on your own. Now, one thing we need to remember about S corporations is that they are pass-through entities. Again, what that means is that the company does not pay income tax on the profits the individual owners will pay income tax on those profits. So when the corporate tax return is prepared and the profit is calculated, then those profits and some other items are going to be passed through to the owners. And the way that happens is the tax preparer will complete a Form K-1. The Forms K-1 tell the Internal Revenue Service this is how we're allocating these profits and losses and other items and who they are going to be allocated to. You as the owner are going to receive a Form K-1, and all of those amounts on that Form K-1 need to go on your tax return. That's how you know how to report the amounts on your return that come from the S Corporation. One thing we need to understand is that if you, the owner, incur any business expenses that are paid out of your pocket, you cannot deduct those expenses on your personal tax return. They can only be deducted on the corporate tax return. So when the preparer of the corporate tax return is working on the books, getting them correct, you need to make sure that they know of all the expenses that were paid for the company, regardless of whether they came out of the company bank account or your personal bank account. They are all deductible on the corporate tax return. Now, one question a lot of my clients ask is, are distributions from an S corporation taxable to me? No, they're not. Let me illustrate that. Let's assume in year one the company generated $10,000 in profit, but only distributed $6,000 of that profit in a dividend. The owner is going to pay income tax on the $10,000 worth of income that was generated, not the $6,000 that they received. Let's assume in year two it generated another $10,000 in profit and was able to distribute $12,000 in distributions to the owner. How is that taxed? Again, it's not taxed. $4,000 of that $12,000 will be allocated to last year's profit that was not distributed. It will be considered distributed this year. And now $8,000 of the $12,000 that was distributed would be considered the distribution for the current year's profits. And as you can guess, we still have $2,000 left over that we can distribute in subsequent years. Now, I promised to talk a little bit about distributions and classes of stock. What does that mean? It really doesn't have much bearing if we have a single member LLC. It does come into play if we have more than one member in this LLC, and it goes like this. Let's assume that owner A and B each own 50% of the profits of this LLC. If $10,000 in distributions are made to owner A and B, then each one of them should have received $5,000 each. Is it possible that one could have received $4,000 and the other could have received $6,000? Not if we have one class of stock. It is not possible. If that happened, we must have more than one class of stock and the S corporation will be terminated. So when we're making distributions in an S corporation, we need to make sure that the timeliness of the distributions and the amount of the distributions are consistent with the class of stock that we have. Meaning that if stockholder A gets a $4,000 distribution on March the 15th, then stockholder B should get a $4,000 distribution on March the 15th. Now, if stockholder B wanted an additional amount of money on March the 15th, could they take it as a distribution? Not unless stockholder A is going to take in a distribution also. Or stockholder B could borrow some money from the company. Now, if it borrows money from the company, that's not a problem, except it has to repay that money in some future time. Quite possibly it will replay like this. Let's say the company gives a $2,000 distribution on June the 15th to stockholder A. Could the distribution be given to stockholder B of $2,000 on the same day, and then the stockholder can repay the loan of $2,000 on June the 15th? Absolutely, and it's very common way to get money out in a disproportionate manner, in a disproportionate amount, at disproportionate times. I hope I've answered most of your questions about how S corporations work, and especially in light of them being an LLC. However, if you have some additional questions that I could answer, I would be happy to. Please email me at Bradley@WBCooperCPA.com.